Hey everyone, welcome back to the channel. My name is Dee and this is Market Talkers. Now most of you know me as a professional prop trader who trades things like crude oil, gold, equity indices such as ES and NQ, all intraday. But in 2008, before my futures trading career and before I got good enough to trade intraday successfully, I started off swing trading Forex. But I don't swing trade Forex, and I haven't done any Forex swing trading since 2012. Instead, I've been trading hard commodities futures and equity indices futures. Instead, I've been trading crude oil futures, gold futures, and equity indices futures almost exclusively over the last decade. In fact, whoever comes to me for training, I actively try to move them away from this idea of trading Forex in general. Why? Well, there's a very, very good reason for it. In fact, there's at least 3 reasons for it. Make sure you watch until the end because the final one is going to be an eye-opener. Now, before we begin, drop any questions that you have down in the comments and consider subscribing to the channel, especially if you're looking to find out just how professional traders like myself manage to stay consistently profitable over long periods of time. I have a ton of free videos here on YouTube about what sort of strategies I use and how I solved some of the issues that I had when I was first starting out. So whatever you're struggling with, I've been there at some point and I found a way out. Let's cue that intro. Without further ado, reason number 1, daily ranges are tiny. Daily range is an average measure taken from 10 to 20 previous trading days that can tell you with quite a lot of accuracy just how much movement you're going to get on most days. It's all about probabilities. Now, in 2022, when I'm making this, the ranges in Forex are very small. Even the best intraday trader cannot make money day trading something that is effectively not moving enough. We live in a very different world today versus the 80s, 90s, and noughties. Noughties is a British term for the decade from 2000 to 2009. But up until the credit crunch of 2008, Forex was an amazing asset class. Strong trends, daily movement of about 170 to 300 pips per day. It was the norm. But since then, we've had not only the credit crunch, but also Europe almost going bust and introducing austerity measures. Then we had the Federal Reserve quantitative easing program. That's basically just a fancy term for
printing money.
And then in the last 2 years, we've had the COVID outbreak that has bankrupted the entire world, just as we were starting to recover. So what's that done to the Forex markets? Well, initially when these troubles started, the central banks decided to depreciate, meaning to lower their currency prices in order to make their exports more appealing. Why? Because that's the stuff that helps, stimulates the economy, yeah? So everything plummeted. I live in the UK, and I remember going to Florida for a songwriting trip in 2008, literally like a week before the credit crunch, when I was still a touring musician. And I remember doing some shopping when the British pound versus the dollar was 1.85. And I mean, at its highest, at one point, it was actually $2 to £1. That movement culminated in November 2007. Now here you can see that massive drop as an after effect of the credit crunch. And even then, that brought huge opportunities. So here was still fine, absolutely fine with Forex. This is around the time when I started trading seriously. It was amazing. I mean, the momentum was totally wild. In fact, I made my first 6-figure account trading nothing but supply and demand on the daily and weekly charts on euro dollar, which kind of echoed this jump off a cliff in the British pound that you see here. Now, with these kinds of moves, the momentums are generally very, very forgiving when it comes to the poor trading locations. Because in momentum and trending markets, the skill is not really all that needed. You can just kind of vaguely identify a trend and then just, hold on to it. The momentum would very quickly take the price away from your entry, whatever that entry was. And then it would stay away for days, weeks, or even months on end. Similar thing happens in bull markets as well, most recently in crypto space, where, I'm sorry to say this, but you have a lot of shit traders who think they're the business, right? Because they did manage to make money in a super easy momentum-based market. So that seduces them to think that they're really good. And back then, when Forex was still great, the duration of your trade or strategy used to get into trades, it just didn't really matter. But these days, in Forex, you're lucky if you get like 70 pips in an entire 24 hours. Some of the pairs only move like 20 to 35 pips, like the Swiss franc, for example. Now that is an abysmal range, okay? Reason number 2, lack of clean trends. Low daily ranges don't necessarily have to be too much of a problem if the market moves in one direction. But Forex trends these days of that sort are few and far between. So let's have a look at the weekly chart of Euro-dollar. Weekly chart. Okay? It looks like it's trending down, right? But let's analyze the composition of the candles and the quality, aka the speed of the fall. There's this 1 week where the price finally turns around, it kicks off a downtrend and leaves the range that the price has been dancing in for about 8 weeks. And then what follows is like a bunch of these neutral looking candles that also stay in a range for another 15 weeks. 15 weeks before the downtrend finally continues. And then 1 week of a dedicated move down, woohoo, followed by another 5 weeks of torture. And then another 2 weeks of moving down, followed by an extended torture period of up, down moves like the horse drawers. Neutral candles like everywhere at a time of the year, Christmas period, when statistically traders used to make an absolute killing for the year. Now let's compare this downtrend to the old 2008 downtrend in numbers. A trendy move down in 2008 over a 5-week period gave us a move of 1,375 pips. And now a move over a 5-week period, and that's when you have the market moving at all, so I'm being very forgiving here with the kind of examples that I'm picking. So this move down is only 411 pips. That's it. So that's like 3.3 times less than what we used to have. Okay, now for reason number 3. And this one is the reason why things are the way they are today. It's a big one, so listen up. But before that, do you have any questions for me so far? If you do, pop them down in the comments. Are you someone who is still trying to trade Forex? How is that working out for you? Did you ever wonder, you're sitting there watching it not moving, losing trade after trade after trade. Did you ever wonder that maybe it's the asset class rather than you? And has this video helped you so far to understand why that is? If you say yes to any of that, well, now is the time to press the like button to let me know that you found this information useful. Okay, so now it's time for the final one, the big one. Number 3, third reason why Forex is not a great choice for trading of any sort in 2022. Global interest rates at near 0% or even negative in some cases. So why is this a big one? Because the momentum of the currencies is directly driven by the difference between the two countries' interest rates that make up the pair. Historically, you had something called the carry trade, which was a strategy that banked on selling the currency of a country with a low interest rate. For example, traditionally this was like something like the Japanese yen, and then buying another currency with a very high interest rate, such as the Australian dollar or even New Zealand dollar that used to have some like absolutely bonkers interest rates. So that differential between the interest rates drove a crazy amount of momentum back in the day. But after the credit crunch, things started to change. Central banks started to lower their interest rates in an attempt to keep the country cash flow positive. So now nearly all Western countries in the world, including Australia and New Zealand, have interest rates that are near zero. So there's nothing to drive momentum. Carry trades used to be a really easy strategy for hedge funds to generate profit. But a carry trade these days, it just doesn't exist anymore as a strategy. So until the interest rates go back up to some historical averages, Forex as an asset class will remain a dead, decomposing, beached whale waiting to explode, taking all of your hard-earned money with it. So what are the alternatives? What can you trade? Well, you're in luck because there are so many other less annoying, less frustrating asset classes such as the futures markets. In particular, my favorite, hard commodities futures such as crude oil and gold. but also equity indices such as S&P 500, NASDAQ, Dow Jones, and Russell. And if you wonder what trends look like on some of those, let's have a quick gander before I sign off. Now, this is during the summertime, like August, when traditionally, even back in the good old days, Forex used to dry up completely, right? But crude oil futures, still a nice clean trend up. And then let's have a look at the corrective move down that came right after this. 1,700 ticks. So when you have these sorts of clean trends showing on large time frames, you can count on having some incredible intraday opportunities and swing trading opportunities that have that momentum component to push your trade along. So can you trade Forex in 2022? Well, you can, but please don't. That's all I have for you. Here are some of my other videos that may be of interest. Goodbye!